You have been told your whole investing life that the path to retirement looks like this. Save aggressively for 30 or 40 years, accumulate a large enough nest egg, and then live off a conservative 4% withdrawal every year. That is the plan. That is the rule. That is what the financial planning industry has handed to essentially every working person in America for decades. And I am going to be completely straight with you today. For most people, that plan is either going to take too long, require too much capital, or both. The math of the 4% rule demands a very specific thing from you. A very large pool of money sitting mostly in assets that are not generating meaningful current income. And then, you are supposed to sell a little bit every year and hope the market cooperates. But there is another set of numbers. Numbers that most people have never sat down and seriously looked at because the products that generate them did not really exist in their current form until recently. And those numbers change the entire conversation about when income independence is actually achievable. And for whom. That is what this video is about. At Dividend Desk, we track over 190 covered call ETFs every single month. We filter them, analyze them, stress test them against real criteria, and separate the ones that are genuinely earning their distributions from the ones that are quietly returning your own capital dressed up with a yield number. Today, I am releasing the results of that filter. The 5 categories of high-yield ETFs that passed every single test we applied. And if you have been wondering whether an income-based approach to financial freedom is realistic for someone at your stage and with your capital, I want to show you the actual mathematics that answer that question before the end of this video. Welcome back to Dividend Desk. Before we go anywhere near a specific fund, I want to lay out the framework we use to get to this list. Because the framework matters just as much as the results. The income ETF space is currently flooded with products, many of which look extraordinary on the surface and are deeply problematic underneath. There are funds paying 40, 60, even 100% annual yields right now, and almost none of those headline numbers mean what most investors think they mean when they see them. So before any investor should even glance at a fund's yield, there are 3 questions that have to be answered honestly. First, is this fund actually earning the income it is distributing, or is it slowly returning principal to investors under the guise of yield? Second, is the fund's price holding its value or growing over time? Or is the NAV, the net asset value, declining as a direct consequence of the distributions being paid? And third, is the income being generated in a tax-efficient structure, or is the headline yield being significantly eroded by the tax treatment of the distributions before the investor ever sees a dollar? Every fund in today's video has been tested against all 3 of those questions. We applied strict numerical filters, a minimum 10% annualized distribution rate, a minimum 15% one-year total return including distributions, and, this is the most important one, positive price appreciation over the trailing 12 months. Not flat, not slightly negative. Positive. Funds where the NAV has declined even while paying distributions are disqualified, because a fund that is giving you back your own capital while the price slowly falls is not generating income. It is liquidating your position for you in monthly installments. 190 covered call ETFs went into the filter. The 5 categories you are about to see are what came out of it. And I want to be transparent about one more thing before we start. The data I am working from reflects specific distribution rates and price returns at the time this analysis was conducted. These numbers will move. Yields change with market volatility, interest rates, and option premium environments. The funds I am naming today are not permanent buy and hold recommendations for every possible future market condition. What they are is the current best representatives of each category, selected using a methodology that you can apply yourself on an ongoing basis to keep your income portfolio calibrated to what is actually performing. With that established, let us get into the income math, because this is where the mindset shift happens. Most people's mental model of income from investments looks something like this. Invest in dividend-paying stocks, or a dividend ETF yielding roughly 2.5 to 3%, collect the distributions quarterly, and reinvest until the portfolio is large enough to live on. That is a valid, long-term compounding strategy, and it has worked for generations of patient investors. But let me show you what the actual dollar numbers look like across 3 different yield levels on the same starting capital. Because when you see them side by side, the difference in what each one means for your timeline becomes impossible to ignore. Take $500,000 invested in a high-quality Dividend Aristocrat portfolio, yielding approximately 2.67%. That generates roughly $13,350 per year in income, about $1,112 per month. Real money, but not a salary replacement for most households. Now take the same $500,000 invested in a well-constructed high-yield covered call portfolio, averaging 11% across the position. That generates $55,000 per year, approximately $4,583 per month. Now we are having a materially different conversation about what financial independence actually looks like. And at 20% blended yield, which is achievable with the right mix of the fund categories we will discuss today, $500,000 produces $100,000 per year, $8,233 per month. That is a full income replacement on a capital base that a disciplined saver can realistically build in 15 to 20 years rather than 35. None of these numbers require a $10 million portfolio. They do not require waiting until 65. What they require is selecting the right instruments, understanding exactly what makes them generate income without eroding your principal, and building the portfolio with the kind of structural discipline that separates income investors who thrive over the long run from those who chase yield and eventually find their principal has disappeared. That is what today's 5 categories are designed to give you. Let us start at the foundation. Category 1 is the S&P 500 Covered Call ETF, the most foundational layer any income portfolio built around covered call strategies should contain. By starting here, you are building your income generation on top of the 500 largest, most financially durable companies in the United States. Whatever happens in more specialized areas of the market, the S&P 500 provides the broadest base of underlying business quality and diversification available in a single instrument. The covered call strategy layered on top converts a portion of the market's price appreciation into consistent monthly income. The key variable in this category is how aggressively the fund writes those options, meaning how much upside it is willing to give up in exchange for premium income. The fund that stands at the top of this category in the current environment is TESPI, the TAP Alpha SPI Growth and Daily Income ETF. TESPI is a relatively young fund at approximately a year and a half old, but it has made a strong statement in that short period, generating an annualized distribution rate of approximately 14.72%. The mechanism behind that yield is something called a 0 days to expiration or 0 DTE option strategy. Here is how it works in plain language. Every single morning, TESPI sells options on 100% of its portfolio that expire the same afternoon, typically written at or very close to the current market price. The fund collects premium income from those options every trading day. And because options that expire the same day have a high time decay rate, those premiums are meaningful relative to the option's cost. At the close of each day, the options expire. The fund resets completely the following morning and writes new options. That daily reset is the source of both the high yield and the question most experienced investors immediately ask. If you are writing options at the current price every morning, are you not capping your upside every day? The answer is technically yes on a daily basis, but the practical consequence over time has been more nuanced than that implies. Because the cap resets every morning, the fund can participate in gradual sustained price trends across multiple days, even if each individual day's upside is limited. The data backs this up. TESPI delivered approximately 2% in positive price appreciation over the past year while paying distributions consistently every single month, including during the sharp market correction in April 2025, when many income funds saw their distributions cut or their NAV decline. That combination, High income consistency through market turbulence plus positive price return is exactly the profile the filter is designed to find. For full transparency, two other S&P 500 covered call funds, GPIX from Goldman Sachs and SPYI from ENEOS, have delivered stronger total returns than TESPI at approximately 18, 16, and 17.66% respectively since their inceptions. Their option strategies are less aggressive on income extraction, which means they capture more of the S&P 500's upside and generate somewhat lower current yields. If your priority is maximum total return and you are reinvesting all distributions, GPIX or SPYI may be the better construction for the S&P 500 sleeve of your portfolio. If your priority is maximum current income and income consistency through volatility, TESPI currently leads this category. Category 2 is the NASDAQ 100 Covered Call ETF, and this is the category that generates the most questions in the income investing community, partly because the underlying index is so volatile, and partly because the tax efficiency differences between the funds in this space are enormous and almost never explained adequately in the content that covers them. Let me address both of those points directly. The NASDAQ 100 contains the 100 largest non-financial companies listed on the NASDAQ, predominantly technology, but also consumer, communication, and healthcare names that have been the primary drivers of U.S. equity market returns over the past decade. Companies like Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla represent the bulk of the index's weight. The higher volatility inherent in this index relative to the broader S&P 500 means that options written against NASDAQ 100 positions generate larger premiums. More volatility means more uncertainty. More uncertainty means option buyers pay more for protection, and that higher premium flows directly to the covered call funds that are selling those options as income. The top performer in this category is QQQI, the ENEOS NASDAQ 100 High Income ETF. QQQI was awarded Best New Active ETF at the 2025 ETF.com Awards, which is meaningful independent recognition from the industry rather than a marketing claim. Its current distribution rate is approximately 14.11%, and it has delivered approximately 5.45% in positive price appreciation over the trailing 12 months, easily clearing the NAV erosion filter. But the most important thing to understand about QQQI relative to many of its peers in this category is the tax structure. QQI writes its options directly against the NASDAQ 100 index itself, using NDX index options. This is a critically different approach from funds that write options against an ETF that tracks the NASDAQ 100. When you write options against the index directly, those options are classified as Section 1256 contracts under the U.S. Tax Code. And Section 1256 contracts receive a specific and extremely favorable tax treatment. 60% of the gains are automatically classified as long-term capital gains and only 40% is short-term, regardless of how long the position was held. For an investor in the 32% federal tax bracket, that 60-40 split versus the 100% ordinary income treatment that ELN-based funds generate can mean a real-world difference of 10 to 15 percentage points in after-tax yield on the same headline distribution rate. That is not a minor detail. That is the difference between an 11% after-tax yield and a 9% after-tax yield on the same nominal income. And over years of compounding, that difference is enormous. QQQI also actively manages its options overlay, typically writing calls against approximately 75 to 90% of the portfolio, rather than the full 100%. That uncovered portion participates freely in NASDAQ 100 price appreciation, which is how the fund has managed to grow its NAV while still paying a 14% distribution. For investors who want NASDAQ 100 exposure with income and are using a Roth IRA or other tax-advantaged account where the Section 1256 distinction becomes irrelevant, GPQ from JP Morgan and QQA are also worth evaluating since they cleared the filter criteria. GPIQ from Goldman Sachs is another strong option across any account type. It combines Section 1256, adjacent tax efficiency through its index options approach, with active management that has delivered strong total return since inception. The NASDAQ 100 category offers genuine diversification of fund approaches within a single index exposure, and mixing 2 or 3 of these with different structures and yields can produce a more robust income outcome than concentrating entirely in one. Category 3 is the Russell 2000 Covered Call ETF. And to understand why this category is particularly interesting in the current macro environment, you need to understand the specific relationship between small-cap stocks and interest rates, because it is more direct and more powerful than the relationship between interest rates and almost any other equity category. The Russell 2000 is an index of approximately 2,000 smaller U.S. companies. Unlike the mega-cap technology companies that dominate the S&P 500 and NASDAQ 100, most small-cap companies are domestically focused, rely heavily on variable-rate debt to finance their operations and growth, and do not have the enormous cash reserves or bond market access that allow large companies to weather a high-rate environment with relative ease. When interest rates rise, small-cap companies feel it immediately in their income statements. Their floating-rate borrowing costs climb directly with the rate, margin compression follows, and the stock prices fall to reflect the reduced earnings outlook. That is exactly what happened to small caps from 2022 through most of 2024. But the inverse is equally true and equally powerful. When the Federal Reserve cuts rates, small-cap companies receive immediate, direct balance sheet relief. The floating-rate debt that was punishing their earnings becomes cheaper. Margins expand, earnings projections improve, and because small-cap valuations had been so compressed by the rate environment, trading at historically wide discounts relative to large caps throughout 2023 and 2024, the potential for price appreciation as that valuation gap closes is substantial. That discount plus rate relief plus elevated volatility from the uncertain macro environment creates 3 overlapping conditions that are specifically favorable for a covered call income strategy built on small-cap stocks. More room for price appreciation, more option premium income from the elevated implied volatility, and a genuine macro catalyst driving the underlying holdings higher. The fund that is capturing this opportunity is IWME, the NEOS Russell 2000 High Income ETF. IWMI holds the Vanguard Russell 2000 ETF as its core equity sleeve and applies the same tax-efficient out-of-the-money covered call overlay that NEOS uses across its fund family. The current distribution rate is approximately 14.69% based on its most recent $0.60 per share monthly distribution, and the fund delivered approximately 8.53% in positive price appreciation over the trailing 12 months. That combination of 14% plus income and nearly 9% price growth while the broader market has been wrestling with volatility is a genuinely strong outcome that reflects both the fund's quality and the favorable macro conditions for its underlying index. For income investors who are concerned, rightfully, about overexposure to large-cap technology, IWMI provides something that almost no other covered call fund in a standard income portfolio provides: a source of income and price appreciation that draws from a completely different pool of economic activity. Small manufacturers, regional financial companies, domestic service businesses, health services, energy infrastructure. These are the kinds of companies that populate the Russell 2000, and they respond to completely different economic forces than Apple or Microsoft. Adding IWMI to a portfolio that is primarily TESPI and QQQI does not just add a third fund, it genuinely diversifies the income engine. Category 4 is alternative assets, and specifically gold, which has been one of the dominant stories in global financial markets over the past 12 months, and which raises a question that comes up constantly from income investors. Gold sounds great as an inflation hedge and a safe haven, but it pays zero income. How do you generate cash flow from something that just sits there? The answer is IGLD, the FTGF Gold Strategy Target Income ETF, and understanding how it works is one of the more genuinely fascinating exercises in financial engineering available in the retail ETF market today. IGLD's current distribution rate is approximately 21% as of its most recent distribution, and it has delivered approximately 41.82% in price appreciation over the trailing 12 months. Both of those numbers are extraordinary, and both require explanation, because on the surface they seem impossible for a gold-linked income strategy. The first thing to understand is that IGLD does not hold physical gold. It does not hold gold futures directly. Instead, it uses a synthetic structure that combines long call options and short put options on GLD, the SPDR Gold ETF, to replicate gold's price movement almost exactly, while simultaneously freeing up the fund's entire cash balance. That freed cash is invested in short-term U.S. Treasury securities, which adds a layer of interest income on top of the gold price exposure at essentially zero additional risk. So before a single covered call is written, IGLD is already generating income from two sources: the option structure that creates gold-like price exposure and the treasury interest on the cash. Then, to convert the gold exposure into a substantial monthly income stream, IGLD sells short-term covered call options against the synthetic gold position. But they do not write these calls blindly. They use what is called a target income approach. Every month, the fund's managers aim to generate a yield that is approximately 3.85% above the current one-month Treasury bill rate. That target adjusts dynamically with rate conditions and with gold's implied volatility. Over the past year, gold's implied volatility has been elevated by geopolitical uncertainty, central bank buying demand, and investor flight to safety, which means the covered calls IGLD has been selling have been generating much higher premiums than they would in a calmer gold market. That elevated premium environment is the primary driver of the exceptional 21% distribution rate. Will that rate persist indefinitely? No, and I want to be direct about that. Gold volatility will eventually normalize. When it does, IGLD's yield will compress towards something more moderate, likely in the 10 to 14% range depending on prevailing rates. That is still an excellent income return on an asset that traditionally pays nothing. But investors who buy IGLD expecting 21% to be a permanent feature should understand that it reflects current market conditions rather than a structural long-term outcome. The most important structural feature of IGLD for anyone concerned about NAV is the partial overwrite approach. In a strong gold bull market like the past 12 months, gold up approximately 76% over the trailing year, IGLD leaves a portion of its synthetic gold position uncovered. That means it participates in a significant portion of gold's price appreciation rather than capping it entirely, which is why the fund's NAV has risen so substantially even while paying large distributions. The fund is genuinely earning both its income and its price appreciation. That is what passes the filter. Category 5 is the high-octane niche, the single-sector and single-stock covered call funds that generate the most extraordinary yields in the income ETF universe. I want to address this category with complete honesty because it is the one where the most financial damage is done by investors who misunderstand what they are buying and how it should fit, or not fit, into a real portfolio. Funds in this category include names like GDXY, which focuses on volatile gold mining companies and currently carries a distribution rate exceeding 100% annually. GWE, which focuses entirely on Google and generates approximately 39%. Niche sector funds targeting semiconductors or the top 50 U.S. giants at more moderate 12% target income yields. All of these operate on the same core engine. A synthetic option strategy creates a long position in a specific underlying asset, and covered calls are sold against that position to harvest premium income. The more volatile the underlying, the larger the premium, and therefore the higher the potential yield. The appeal is obvious. An income stream of 39% on a single company bet or 100% on a gold mining play sounds like an incredible opportunity, and if the underlying company or sector happens to have a good year, it can be. The problem is the word "if" in that sentence. Every dollar you allocate to a single stock income fund is a dollar whose entire income stream depends on one company remaining viable, growing, and not experiencing a catastrophic regulatory, competitive, or operational event. If Google has a genuinely terrible year, If it faces serious antitrust action, if a major AI competitor takes meaningful market share, if advertising revenue declines significantly, your GAY distributions shrink and your NAV gets compressed simultaneously. You are experiencing both a pay cut and a capital loss at the exact same moment. There is no other part of the portfolio cushioning that blow because there is no other part of the portfolio. Every egg is in one basket. The contrast with broadly diversified funds like TSB or QQQI is stark. When those funds experience a difficult period, it means the S&P 500 or NASDAQ 100 as a whole has declined, which means virtually everything in the equity market is declining too. The income buffer they provide still works mechanically even in that environment, and the recovery is driven by the same broad market forces that eventually pull every major index back to new highs. Single stock funds do not have that recovery mechanism. A company can underperform the market indefinitely or even permanently if its competitive position erodes. The correct framework for these niche funds in a real income portfolio is satellite allocation. They belong in the 5 to 15% range of your total income exposure as yield kickers that boost the blended return of an already diversified foundation, not as the foundation itself. If 10% of a $300,000 income portfolio is in GAY and Google has a catastrophic year, the impact on total portfolio income is painful but survivable. If 100% is in GAY and Google has a catastrophic year, you have no income engine left running while you wait for recovery. The difference between those two outcomes is not the fund selection. It is the position sizing. Used as a small satellite with clear eyes about the concentration risk, these funds can meaningfully enhance the overall yield of a well-built income portfolio. Used as a core holding, they are a retirement income plan built on a single company's quarterly earnings. That is not a plan I would recommend to anyone. Let me now show you how all 5 of these categories work together in a real income portfolio structure, because understanding the individual funds is only half the work. Understanding how to combine them in proportions that maximize income while managing risk is what separates investors who build durable income streams from those who end up chasing yield and discovering too late that their portfolio is more fragile than they realized. The structure I am proposing has 3 distinct layers, each serving a specific function. The first layer is the diversified index foundation, approximately 50 to 60% of total income allocation. This layer should contain 2 or 3 of the broad index-covered call funds, TSB or SPYI or GPIX for S&P 500 exposure, and QQQI or GPIQ for NASDAQ 100 exposure. Within this foundation layer, the choice between TSB and SPYI or GPIX comes down to your priority. Income-first investors lean toward TSB's higher distribution. Total return investors lean toward SPYI or GPIX. Within the NASDAQ 100 sleeve, your account type matters enormously. In a Roth IRA or 401k where tax treatment is irrelevant, GPQ is fully competitive. In a taxable brokerage account, QQQI's Section 1256 tax efficiency makes it meaningfully superior to ELN-based peers. This foundation layer should deliver a blended yield of approximately 12 to 14%, depending on the specific funds chosen. And it should hold up well through most market environments because the underlying indices are the broadest, most liquid equity benchmarks available. The second layer is diversified alternative income, approximately 25 to 30% of total allocation. This layer contains IWMI for small-cap Russell 2000 exposure and IGLD for gold-linked income. These 2 funds serve distinct diversification purposes. IWMI diversifies away from large-cap technology dependence and provides income that is driven by different economic forces, domestic business activity, rate cycles, and small-cap valuations, rather than AI chip demand and mega-cap growth. IGLD provides income from gold exposure, which tends to move inversely to risk asset performance during periods of market stress, meaning that when the equity-linked funds in your foundation layer are under pressure, IGLD's distributions may actually be holding steady or even growing. That non-correlation within the income stream is genuinely valuable for an investor who is living on the distributions. The blended yield from this layer, using current distribution rates, is approximately 16 to 18%, boosting the overall portfolio yield above what the foundation layer alone would generate. The third layer is the niche satellite positions, no more than 10 to 20% of total allocation. This is where the single stock or single sector high-yield funds belong, sized carefully and with clear understanding of the concentration risk each one carries. A position in GI or GDXY or a semiconductor-focused income fund in this satellite layer adds meaningful yield to the overall portfolio blended rate without creating existential dependency on any single company's performance. Running the overall math on this three-layer structure, a $400,000 portfolio built with 55% in the diversified index foundation, 30% in the alternative income layer, and 15% in satellite niche positions can realistically generate a blended yield in the 13 to 16% range, producing approximately $52,000 to $64,000 in annual distributions. That is $4,300 to $5,300 per month in income from a capital base that many serious investors in their late 30s or 40s could realistically have accumulated. Not millions, not a 30-year savings marathon, a focused, structured approach built on instruments that are generating real returns and passing real filters. Before I close, I want to make one final point about the environment these funds are operating in. Because context always matters, and the current context is unusually favorable for covered call income strategies in ways that may not persist indefinitely. All 5 of the fund categories highlighted today have been operating in a period of elevated market volatility and relatively elevated interest rates, both of which increase options premiums and therefore the income available to covered call strategies. Higher volatility means option buyers pay more for coverage, which means more premium income for the fund selling those options. Higher rates mean the treasury income embedded in strategies like IGLD is more generous than it would be in a zero-rate environment. These conditions have made the past 2 years particularly strong for income ETF performance. They will not last forever in their current form. At some point, volatility will normalize. Rates will fall further, and the yields in this space will compress somewhat. The funds with the most aggressive overlay strategies, those writing the most calls at the tightest strikes, will see the biggest yield compression. The funds with more flexible, active approaches that can adjust their strategy dynamically, like QQQI and GPIQ and IWMI, will compress less because they can adapt their coverage ratio to maintain target income even in lower premium environments. This is one reason the filter criteria used in this analysis specifically require funds with active management approaches rather than passive, mechanical buy-right strategies. Passive strategies pay well when conditions are favorable and have no mechanism for defending income when conditions change. Active strategies can fight back. The filter also requires positive price return, not just distribution yield, precisely because we are now 2 to 3 years into the income ETF boom and the market has had enough time to separate funds that are genuinely earning their income from those that are structurally eroding investor capital. The funds that have maintained positive NAV through a full market cycle, including a significant drawdown in April 2025, while continuing to pay distributions, are demonstrating something real. That survivorship matters. A fund that only looks good in a benign environment is not a fund you should be building your income independence on. That is the Dividend desk standard for income ETF selection, not the highest yield on a screen, not the most exciting ticker, not the one with the best marketing, the one that has earned its distributions, held its value, treated its investors' capital with respect, and managed its strategy well enough to still be standing and paying after real market turbulence. The 5 categories in this video have met that standard as of the time this analysis was completed. Monitor them, reevaluate periodically, and apply the same filter every time conditions change. That discipline is what separates income investors who build lasting wealth from those who chase yesterday's best performer and end up starting over. If this breakdown gave you a clearer framework for how to evaluate and build a high-yield income portfolio, hit the like button. It tells the algorithm that this kind of detailed, honest content is